It's your boy Nature, aka Nature Gang. Alright, so this video right here, I told y'all every day we're gonna be posting. I'm gonna be giving y'all content every day for like, you know what I'm saying? As much content if I can give y'all, I'm gonna give y'all. You know, as much as I can help y'all out, I'm gonna help y'all out. You know what I'm saying? Because I know how it feels, and you know what I'm saying. So let me like help y'all out, help y'all win. Alright, so we're gonna explain this right here. This is just drawing I have. Hold on. Alright, so we're explaining this drawing I have right here. So obviously this is an uptrend because it's going up. And obviously this is a downtrend because it's going down. So usually this will happen when it's going up. It will go up for a little bit, then go back down, test the support level, then go back up to the next resistance. It's going to make a higher high. See how that high is higher than that high? This is how you know it's going up, because it's going to make higher highs and higher lows. So that this low is higher than that low. So it's making higher lows and higher highs. So higher high, higher low. That low, this low is lower than that low. Higher high. That high, this high is higher than that high. Sometimes it'll be just a little bit higher than this high. Lower low, higher low. This high is lower than that high. Higher low, higher high. Boom, back up to higher high. This high is higher than that high. So this is how you can tell if it's going up. It's going to make higher highs, okay, higher highs, and it's going to make higher lows. Okay, same thing with a downtrend. It's going to go up to the resistance, and it's going to go back to the support level. So it's going to make a higher low, and it's going to make lower lows and higher lows. No, it's going to make lower lows and lower highs. Okay, so here goes the lower. This low is lower than that low. This lower high is higher than that lower high. This lower high is higher than that lower high. And then it'll go all the way up. So before it goes all the way up, it'll go all the way back down. Then it'll go up. Same thing here. It'll go all the way back up, and then it'll come back down. Okay, so this is like a way. This is one of the ways. I'm gonna be showing y'all. Like, I'll show y'all actually more examples of it in the charts and stuff. Like when actual market, when I to show y'all higher highs and higher lows too. But this is just an example. It's a good example of how you can identify a trend. Also, it makes a W. Every time you see a W pattern, like, you have to see it. It's going to see a W. You're going to see a W pattern. Once you see a W pattern, usually it's going up when you see W patterns. Okay, but you have to let that W pattern form first. So you have to let it form. You have to let it do what it do, and then once that W is making, and you see the W's like right here, and it's going up, it's making a W going back up. Same thing with here on a downtrend. A downtrend is going to make an M. So it's going to make an M. M means going down, and W means it's going up. Okay, so when you see a M being made in the market, that means it's going down. Okay, and when you see a W being made in the market, it means it's going up. That's another way that I make a lot of money, that I'm able to identify which way the trend is going very fast, is looking at, seeing if it's higher highs, meaning, and higher lows means it's going up, or to see if it's lower lows and lower highs to see if it's going down. Looking at the W's, looking at the M's, you want to look at everything. So this is a quick drawing of something that really helped me, that I learned over the time of studying and stuff and making errors and trying over and over again. So I hope this helped. Alright, so we're going to also just refresh back up on yesterday's lesson. We was talking about doji candlesticks. So doji candlesticks suggest or a struggle for turf or position between buyers and sellers. So remember, doji candlesticks are like this. They're in the, like, they have thin bodies, okay, and they usually and it's usually a suggestion that buyers and sellers are indecisive, or a reversal's coming, or a reversal's coming in the uptrend. If you see a doji after a white candlestick, a reversal's coming, so sell. If you see a doji after a black candlestick, a reversal coming, so buy. Alright, so for doji candlesticks, when doji form on your chart, pay special attention to the preceding candlesticks. Okay, so doji form series of candlesticks with long hollow bodies, and it usually come after a white marabosal or a black marabosal. okay? And the doji signal, if you see it on a white marbozo, if you see it in the uptrend, and you see a doji right after that, it's, you know, the doji signals that the buyer's becoming exhausted and weakening, and the reversal is happening. Same thing here. If you see a doji forming in a series of candlesticks with long hollow bodies, long fill bodies, long black fill bodies or red bodies, and it's a doji right after it, like a plus sign after it, then that means that that buyers, that this doji signal after that means that sellers are getting exhausted and weakening, and buyers are coming in. So you want to buy when you see this pattern, okay, right after that, and you want to sell when you see this pattern right after that, okay. So hope that helped. All right. So we're just going to refresh up on that. We're going to talk about Merbozo. Remember, a Merbozo candlestick has no shadows. Okay, it has no shadows from the body or the ball head. It has no shadows or wicks. So a Merbozo candlestick won't have any shadows or wicks. Okay, so a white Merbozo, if a white Merbozo forms at the end of a uptrend, it's continuing likely. So if you see it, a white Merbozo like candlestick at the end of an uptrend, a reversal is most likely happening. If you see it at the end of a downtrend, a reversal is most likely happening. So you see a big candlestick, a white big candlestick, or a green big candlestick, and it's at the top of the uptrend, is most likely continuing that direction. All right, but if you see a white candlestick or a green candlestick form at the end of a downtrend, a reversal is likely to happen. Okay, so those are the two ways. It can either go up or down. Okay, they have both two meanings. Okay, so I just want y'all to understand that. So if you see it at the bottom of a downtrend, it's a reversal. If you see it at the top of an uptrend, it's a continuation. Okay, same thing with the black marbozos. Okay, or the red marbozos. If you see a red marbozo, a long red candlestick or black candlestick at the end of a downtrend, a continuation is likely. If you see a long black candle at the, or a long red candle at the end of an uptrend, then a reversal is most likely happening. Okay, so I just want y'all to understand that. That's how I read the market. This is how you read the market. It's 95% trading in this market is technical. Okay, it's understanding candlesticks, understanding the reversal patterns, understanding key levels. We're also going to talk about key levels, okay, and understanding where price actually wants to go as far as in the market and how they use their numbers and all that. Okay, so I got y'all with that too. All right, so I just wanted to fresh up on yesterday's lesson when we was talking about Japanese candlesticks. We was talking about dojis. We was talking about all the single candlestick patterns, double candlestick patterns. I just wanted to fresh up on that. Remember, long bodies indicate. So when you see a long body, a strong long body, it indicates a strong buying or selling is happening. Okay, the longer the body is, the more intense the buying or selling pressure is. Okay, so same thing with long shadows. So so you see long shadows. So these are long shadows. Okay, it means that action is occurring, and in a strong action. If you see a long wicks coming, strong action is occurring in that direction. So if you see a long wick in a little body, then most likely a reversal's coming in that direction. If it's going up, you see the long wick going up and a little body at the bottom, is probably going back up. If you see a long wick though at the bottom, poking out at the bottom, it depends though. It depends where it's at. Because you have to look. Remember, we have hammer. You have to know about hammer. You have to know about inverted hammer. You have to know about hanging man, and you have to know about shooting stars. Okay, which are what goes with the long shadows. Okay, which so you have to spinning tops too. So short shadows indicate that that there wasn't a lot of trading action. That the trading was confirmed near the open and the close. It was very close. Long shadows, the opening in the past was, the trading action was much longer. So We also have spinning tops right here. Spinning tops. Remember we went over spinning tops yesterday. Spinning tops is little bodies with little wicks on both sides. This means that indecisive between buyers and sellers. Okay, so spinning tops formed during the uptrend means a reversal. Okay, so you see a spinning top during the uptrend, and a reversal is coming back down. Okay, you see a spinning top during the downtrend, a reversal is possible, it's going back up. Okay, so I just want y'all to understand those. I wanted to go over that again, so we can go right into the next lesson. All right, so we're going to be talking about how to actually trade. Okay, I'm gonna actually give y'all some tips on when is to trade and when to actually know when to get in, when to get out. Okay, so the aggressive way you can trade will be simply to buy or sell whenever you see price pass through a support or resistance zone. So you have to wait for price to pass through the last resistance zone or the last support zone. Okay, with ease. Okay, you gotta make so with ease. That's, and once you see it like this dropping with ease, you get in. Okay, that's the aggressive way to trade. Okay, that's the aggressive way to trade. Okay, the conservative way to trade for price is to make sure is to wait for a pullback. Okay, because price is always going to pull back. It's not going to always just go straight down or up. Okay, it's going to pull back and then it's going to continue in that direction. This is the conservative way to trade. Okay, because price is going to pull back up. Okay, you can get in early if you want, but price is always going to pull back up. So this is the conservative way to trade, and better actually probably a better way to trade at first. Okay, but like I said, the aggressive way also, sometimes I'm aggressive. Sometimes I just get in a trade because I know where it's going in that direction. Okay, so, but sometimes you want to wait. You want to wait for the conservative way to trade. It's two type of ways. You can trade the aggressive way and the conservative way. Okay, so your stop loss is at the top. You know, your entry order is right there. It went past the support. Okay, so the conservative way is to make sure it pulls back, because it's always going to pull back first. Once it pull back, you get in. Once it pull back, and it goes back down. Okay, that's the conservative way to trade. Okay, this is the aggressive way to trade. Okay, in the market. So you wait for the pullback to the support or resistance, depending on if it's an uptrend or a downtrend. If it's an uptrend, you're gonna wait for it to pull back to the last support, which is on the bottom, and then it's gonna go back up. If it's a downtrend, you're gonna wait for it to pull back to the last resistance before it go back and shoot straight back down to the support, straight back down to the bottom. Okay, so those are like the two ways you could be an aggressive trader or you could be a conservative trader. Okay, so this is the simplest way to trade, a way to trade and to buy and sell whenever price is convincingly. Okay, this is the aggressive way. Aggressive way is to trade when price is convincingly breaking through a support and a resistance zone. So when you see it, price just coming straight down, just breaking through, going straight down, get in there. Okay, that's the aggressive way to trade. Okay, the keyword here is convincing. If it's convincing, because we only want to enter price when price passes through significantly. It has to significantly pass through it, without any hesitation. We have to literally see it and pass through a support or resistance. That's when we get it. Okay, because price will always pull back, and then you could lose money like that because price could pull all the way back. Okay, so you want to wait till you get a clear confirmation that price is going in that direction. Then you want to get in. Okay. All right, that's the aggressive way. Instead, though, you can enter right on the break. You can enter right back on the pullback. Okay, that's just the conservative way to trade. You can pull back. You can get in right back on the pullback, right back on the break. So you wait for price to make a pullback. Okay, you wait for price to make a pullback. Okay, and then once price makes a pullback to either that support or resistance level, okay, then you enter. Okay, then you enter after the bounce. So you want to enter after price makes that bounce. Okay, so this is the constructive way. This is the aggressive way. You see how price is just going straight down? That's the aggressive way, but it's going to pull back up. Just best believe know that it's always going to pull back up. The constructive way is to see how prices went straight down, but you see how prices went straight down, but it's always going to pull back up. The aggressive way is to wait for price to pull back up before you get in a trade. Okay, to wait for price to pull back up and then you get in. Okay, stop loss above the last resistance and you enter right here, your entries right here, and you just write it down. Okay, you want to write it down, and I'm gonna tell you where to write it down to. I'm gonna be showing y'all key levels that I learned from mentors and stuff, from studying. I'm just gonna be giving y'all everything. So those are aggressive way and the constructive way to trade in the market. Okay, so most times you if you feel you're confident and you're aggressive, it's okay to be aggressive, but you want to wait for the pullback. 9 and 10, you wait for the pullback. Okay, you're still gonna make money regardless. So always use a stop loss to get comfortable using stop losses and take profits you once you're profit, you can move your stop loss into profit. Okay, you can do all that. Okay, so you want to wait. Always wait into a pullback. Okay, you want to wait for a pullback. That's the constructive way, the best way probably to trade. And you want to wait for a pullback to the broken support or a pullback to the broken resistance level before going back down in that direction or going up in that direction. Okay, so this always happens. Price will always do this. This will always happen. Price will always pull back up before going back down. Price will always and price sometimes will go back down, and you could get in. It will just shoot back down fast. You can get in. So I just want y'all to understand this is something that always happens in the market. It always pulls back up before going back down, and sometimes it just goes all the way down. Okay, so and you want to get in both times. Okay, so this is what I want y'all to understand. Okay, I hope this helped. All right, so we're almost done. This is the last part I'm gonna teach y'all for right now. So when the market, I just wanted to teach y'all how to trade. So when the market goes to the pullback at the highest point before it reaches a pullback, this is called the constructive way. This is called the safe way. So when the market moves up and then pulls back to the lowest point. So when the market moves up and pulls back to the highest point and then pulls back, okay, down, that last highest point is the resistance. That's the last high. That's the resistance that price went to before it went back down. Same thing here. When the market pulls up or moves up and then it goes to its lowest point and then it reaches back and pulls back up and it climbs back up, that lowest point it went to, price went to before it went back up is now the support. It's the support level, the new support level before price went back up. Okay, price will go back to that support level, and price will go back to that resistance level too. It will always make a pullback. Okay, so be aware of that. Be aware of the pullback. Another thing is uptrend. Okay, see the pullback. So it went up, pull back to the last support, and went to the resistance, made a resistance. Pull back to the last support before going back up. Okay, same thing with a downtrend. It went down, went to the up to the resistance, the last resistance before going back down on a downtrend. Okay, so this is how you can identify when to get in the market. Okay, I hope this video helped. If you like I said, you want to get in aggressively, you're gonna wait for some type of price or candlestick to be falling like a knife. It's going to be falling like a knife, like straight down. Okay, that's the aggressive way to trade, like I said. Or you can wait for price to bounce back up, pull back up to the last resistance or support level, and then get back in, because it's going to go back in that direction anyhow. Some aggressive traders just know it's going to go back in that direction anyhow and doesn't care about the pullback because they already got in a trade. Okay, so it's like it's not really that bad of a loss for them. They're just going to wait for it to pull back and go back in that direction and continue making as much money as they can. So I hope this helped. This is how aggressive way this is aggressive way of me teaching y'all how to trade, and constructive way of teaching y'all how to trade in the market. How to identify, if it's going up or down, if it's in an uptrend or a downtrend. So gang, it's your boy Nature, aka Nature. More videos on the way. I got y'all. Yeah.